Hello, my name is Brian Mattox. I'm the Senior Portfolio Manager here at Kendall Capital. Today, I'd like to spend a few minutes talking about three things that are on the top of our minds when it comes to portfolio management and taxes. The first is realizing capital gains, why you would do it, and the overall effect of that. The second is tax loss harvesting, and how you can mitigate some of the taxes on those gains. And third is capital gains or mutual fund capital gains distributions. Realizing capital gains typically comes from rebalancing the account. Our security has run up. You'll sell that security, buy a security that is underweight, basically maintaining the overall balance of the account and the overall asset allocation. Now, of course, when you realize a gain, the government wants their cut, and depending on how long you hold that security will depend on the tax rate that's applied. Long term is over 1 year, it'll be at the 15% capital gains tax rate, and then short term, less than 1 year, will be at the federal income level. So it's very beneficial to realize or let things go long term. And of course, this only applies to taxable accounts. Your 401, your IRA accounts, obviously this does not apply. To mitigate some of those gains in those taxable accounts, we use what's called tax loss harvesting. And really all that is selling security that's on the books at a loss to offset some of that gain. And some of the analysis that's been done, it's really, investors are more acute to losses than they are to gains. So the extent that we can mitigate some of that pain of realizing a loss or selling a security at a loss to offset taxes, then that typically helps in the minds of investors. The only caveat to tax loss harvesting is you have to, with the security that you sell, you cannot buy that back within 31 days. If you do, the wash sale applies, and that loss will be washed out, and then you, of course, realize the whole gain, and you'll be taxed on that entire gain. The third thing is mutual fund capital gains distributions. These are typically paid at the end of the year. And really what the mutual fund is doing, the mutual manager is buying and selling securities throughout the year. And to the extent that those gains or the securities that they sell, the gains outweigh the losses, they're going to distribute that gain at the end of the year, typically November, December. And it's based on record date. And if you own that mutual fund on record date, you're going to get that capital gain distribution. So a good example is if the mutual fund manager had bought Apple 5 years ago, they sold Apple within this current year for a huge gain. Let's say they sold it in February, and you bought the fund in October. Even though you did not own the fund, you will still be liable for that capital gains tax. So it's one of the kind of, I guess, necessary evils with mutual fund investing, and you have to be very careful not to buy capital gains. And that simply means not buying a fund right before they pay that capital gains disbursement, because you really don't have that benefit of seeing the security appreciate. Instead, you'll just pay the tax on it. So it's kind of a lose-lose situation for investors. If you don't see the benefit of those appreciating securities, but then you buy the mutual fund in that same tax year, the mutual fund manager could have long sold that security for a gain. You don't see the benefit, but you still have to pay the tax on the capital gains. So just be careful. And something we're very cognizant of is not to buy capital gains within mutual funds. So in summary, we've gone over realized capital gains. We've gone over how to mitigate some of those with tax loss harvesting, and then we've gone over some of the mechanics with mutual fund capital gains distribution. Again, my name is Brian Mattox. I hope you found this helpful, and thank you for watching.